Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else.
Friends, welcome to another video on your channel Profit in Equities. Now, given the recent heightened market volatility, investors fearing permanent loss of capital should look at adding some high dividend yield state-run stocks to their portfolio. Here we'll be talking about 6 such safe stocks which provide a very attractive dividend yield and also are strong businesses which command pole positions in the industry. Even if earnings growth is not impressive, this stock should protect investors against market volatility considering their high dividend yield and possibility of higher payouts given the government's deteriorating fiscal situation. All these entities have reasonable growth, low regulatory risks and have high core return on equity. Please watch this video to know more. Now the first stock on the list is Engineers India Ltd, which is available at Rs 116.15 and the face value for it is 5. The symbol for it is ENGINERSIN. Now Engineers India Ltd is an engineering consultancy and engineering procurement and construction company in the hydrocarbons and petrochemicals industry. The company's segments are consultancy and engineering projects and also turnkey projects. Now, as is evident from the 1-year chart, the company has been a wealth destroyer and has been on a downtrend for the last 1 year. Now, pickup in hydrocarbon capex in India and globally would bode well for Engineers India. Over the next 2 years, led by strong order book of close to Rs 7,800 crores or about 4 times its annual sales, the company is expected to report 15 to 17% annual earnings. The stock has corrected 45% from its 2018 high and currently trades at an attractive dividend yield of close to 3.5% and 15 times its FY20 estimated earnings. Looking at the market cap, the company is a mid-cap with a market capitalization of Rs 7,339.65 crores. The EPS of 6.06 translates into a price to earnings ratio of 19.17, which is largely in line with the industry price to earnings ratio of 18.01. The book value of 35.89 translates into a reasonable price to book ratio of 3.24. The company has a promoter holding of 52.02, which is just above average. The 52-week high for the stock stands at 206.40, whereas the 52-week low is 100.15. The second stock on the list is Coal India Ltd, which is available at Rs 278.60 and the face value for it is 10. The symbol for it is COALINDIA. Now, Coal India Ltd is an India-based holding company. This is involved in coal mining and in the production and sale of coal. Now, the Coal India counter has not corrected much in the recent correction. This is more to do with growth expectations led by higher realizations and volume growth. Most of its past issues such as evacuation challenges and wage revisions are now easing. It's a debt-free company sitting on a cash equivalent of about Rs 31,400 crores. The stock currently trades around 12 times its FY19 estimated earnings, offering a dividend yield of close to 6%. Now, looking at the 1-year chart, it's evident that this company has followed a choppy pattern during the last 1 year. The market cap of the company is 1,72,938.42 crores, which indicates that the company is a large cap one. The EPS of 15.03 translates into a price to earnings ratio of 18.54, which is much more expensive when compared with the industry PE of 13.79. The book value of 20.45 also translates into an expensive price to book ratio of 13.62. The promoter holding is a very strong number for this company and stands at 78.32%. The 52-week high for the company stands at 316.95, whereas the 52-week low for the company is 257.30. Now, the next company on the list is NLC India Ltd, which is available at Rs 84.20 and the face value for it is 10. The symbol for it is NLCINDIA. Now, NLC India Ltd, formerly Navy Lignite Corporation Ltd, is engaged in the power business. The company's segments are lignite mining and power generation. It operates approximately 4 lignite mines, including over 3 lignite mines at Neyveli, Tamil Nadu, and 1 lignite mine at Barsinagar in the state of Rajasthan with a total capacity of over 30.60 metric tons per annum. Now, as is evident from the 1-year chart, the company went on an uptrend for the first couple of months of the year, since then had a brutal fall, but however, of late there has been a huge spike. Now, this is probably the only state-run entity that has announced a buyback of its shares, indicating extreme confidence by the management about future growth. The company is into power generation, generating annual cash inflows of about Rs 1,000 crores, which is redeployed to expanding capacity. It recently added about 1,000 megawatts of new capacity which will take care of near-term growth. At the current price, the stock offers a dividend yield of close to 5.5 times and trades at an attractive valuation of 5 times its FY19 estimated earnings. Now the company has a market capitalization of 12,870.55 crores, which indicates that the company is a mid-cap one. The EPS of 12.12 translates into a price to earnings ratio of 6.95, which is dirt cheap when compared with the industry PE of 11.10. The book value of 87.24 also translates into a very cheap price to book ratio of 0.97. The debt to equity here stands at 0.4646, whereas the return on equity for this stock is at a figure of 0.1167. The promoter holding is also a very strong factor for this stock and stands at 84.04. The 52-week high for the stock stands at 119.40, whereas the 52-week low is 65. Now the next stock on the list is Ircon International Ltd, which is available at Rs 368, whereas the face value for it is 10. The symbol for it is IRCON. Now Ircon International Ltd is a construction company which is into the construction of transportation infrastructure. The company's primary charter is the construction of railway projects in India and abroad. The company has also diversified into transport and other infrastructure segments with its expanded scope of operations. Now this company has not had much of a trading history and has only been a recent listing, but even though it got a bumper subscription, price performance has been a letdown. The company is a fast-growing public sector enterprise with an order book of close to Rs 22,400 crores or about 5.6 times its FY18 revenue. At the current market price, the stock is trading at less than 8 times its estimated FY19 earnings and also offers a dividend yield of close to 5.5% at the current market price. Valuations are quite attractive considering growth visibility, cash on books, and high return on equity of about 23%. The company is a mid-cap with a market capitalization of 3,461.10 crores. The EPS of 32.25 translates into a price to earnings ratio of 11.41, which is much more cheaper when compared with the industry PE of 22.22. The book value of 398.93 also translates into a dirt cheap price to book ratio of 0.92. The debt to equity is 0.2116, whereas the promoter holding is also a very strong factor for this stock and stands at a figure of 89.18 post the IPO. The 52-week high is 475, whereas the 52-week low for this company stands at 350.05. Now the fifth stock on the list is Gujarat Mineral Development Corporation, which is available at Rs 93.65 and the face value for it is 2. The symbol for it is GMDC Ltd. Now Gujarat Mineral Development Corporation Ltd is a holding company that operates through two segments, which are mining and power. The company's projects include lignite, bauxite, fluorspar, multi-metal, manganese, power, wind and solar. Now as is evident from the 1-year chart, the company has been a stark underperformer and has been on a consistent downtrend throughout the entire year. Now the stock has corrected over 40% from its 52-week high. The company is sitting on a net cash of close to Rs 1,100 crores on a market cap of close to 3,000 crores. Higher realization, better volume growth in the lignite segment and improvement in the power businesses should ensure higher earnings and cash on its books. At the current market price, the stock is trading at 6 times its FY19 estimated earnings and offers a dividend yield of close to 4%. The company is a mid-cap with a market capitalization of 2,978.07 crores. The EPS of 15.04 translates into a price to earnings ratio of 6.23, which is dirt cheap when compared with the industry PE of 13.79. The book value of 138.41 also translates into a very cheap price to book ratio of 0.68. The company is debt-free and the return on equity for this stock stands at a figure of 0.2620. The promoter holding is also a comforting factor and stands at a strong number of 74%. Now the final stock on the list is Cochin Shipyard Ltd, which is available at Rs 395.15 and the face value for it is 10. The symbol for it is COCHINSHIP. Now Cochin Shipyard Ltd is an India-based company focused on catering both to clients in the defense sector as well as in the commercial sector. In addition to shipbuilding and ship repair, the company also offers marine engineering training. Now as is evident from the 1-year chart, the company has been on a consistent downtrend throughout the entire year. Among shipyards, Cochin Shipyard has strong execution capability and a superior capital allocation policy. It's a debt-free company, adjusting for cash on its books to the tune of Rs 3,000 crores, which is almost equal to its net worth, and 59% of its current market capitalization. Core return on equity is much better. The company is sitting on an order book of close to Rs 1,200 crores or about 6.7 times its sales, providing decent revenue visibility, even if one assumes a slight downturn in defense deliverables. The stock is trading at 12 times its FY19 estimated earnings, offering a dividend yield of close to 3%. Now looking at the market cap, the company is a mid-cap with a market capitalization of 5,371.51 crores. The EPS of 30.30 translates into a price to earnings ratio of 13.04, which is slightly cheaper when compared with the industry PE of 16.33. The book value of 239.51 also translates into a reasonable price to book ratio of 1.65. Another strong factor for the company is the promoter holding, and this stands at a figure of 75%. The 52-week high is 599, whereas the 52-week low for the stock stands at a figure of 356.05. Now friends, please don't consider this to be a recommendation on our part. Please go ahead and do your own research. This and all other content that you see on our channel is intended to be a piece of news. Also, this is not our own research. We will be providing a link to the source for this video in the description section. Please go through it to build more conviction around your investment decision. Thanks for watching, and if you have not yet subscribed to this channel, please consider doing so.